Hello guys and welcome back to the channel. So in this video we're going to talk about why 90% of traders lose money and how you can avoid those mistakes and be in the top 10% of traders who win money. So basically I came across this data that 90% plus traders lose money on the stock market. I have also seen it in firsthand. In my stock market history, 10 years ago, I did a stock market course. At that time, it was a live course. And then we had weekly meetings, which was called a stock market club, where everybody talked about their trades. And I saw it firsthand that 98% of people basically just blew their accounts and lost money. And it's incredible. And I wanted to also look around, is this really true that so many people lose money? So I found this article that says, I just give you the key points here. One study of Brazilian future traders found that 90% of day traders lost money over a period of 300 days. Another study of day traders in Taiwan between 1995 and 2006 found that only 5% of day traders were profitable. As I said, I think this is an overestimation. Like I cannot tell you how many people just come in and don't know what they're doing. They get wiped out and they leave the market forever. A study by the US Securities and Exchange Commission of Forex traders found 70% of traders lose money every quarter on average, and traders typically lose 100% of their money within 12 months. A study of Etoro traders found nearly 80% of them had lost money over a 12-month period. The median loss was 36%. So why is this? So I have quite a few years of experience with the stock market. I have actually blown my first portfolio within a few trades, 100% gone. Then I had another portfolio which did quite well, and then I quit the stock market for some time, and I actually built a quite successful real estate company in southern Sweden. We develop real estate, and I'm part of building hundreds of apartments down here. And as a diversification, I decided to take stock market very seriously and document my journey with this channel. So if you want to see more videos on this, make sure you hit the subscribe button. So I'm no stranger to losing money on the stock market. And as I said, because I was part of the stock market club, I saw how newbies trade on the stock market. And the shocking truth is that most of them lose money and they completely wipe out their portfolios. And I want to tell you why this is and how you can avoid this so you can be in the top 10. So the number one reason why this happens is people don't have a strategy and they don't understand what strategy is, and they begin trading on tips and feelings, and I feel the market is too high, it must come down, or this has fallen so much, it must go up, or Jim Cramer said this on CNBC. And I have to tell you something, the stock market is actually educated gambling. Maybe it feels bad to use the word gambling, but this is the truth. If you, for example, I don't know if you have ever played roulette. What happens is you have black and red fields, and I think there's 36 of them, and there is a green one on the zero. And basically, if you would bet on red, if you bet right, you get 100% of your money. If you bet wrong, you lose 100% of your money. And it's almost equal. But the house, the casino, has this extra zero field. So that means that they have, don't quote me on this math, but they have 1 or 2% more chance over you, because there is 37 places where the house wins and 36 where you win. And because of that 1%, with the time, so it's not that there is no one who wins on roulette, but if you take 10 people and you let enough time pass, the house will always win, because mathematically, as more and more betting plays out, the mathematical advantage of the house will more and more play out in real time. And the stock market is actually very similar. There's two crowds. You have the fundamental crowd And they are guys who analyze companies based on their earnings. They analyze companies based on their future. And normally these people hate on the technical guys. And technical guys, they analyze how the price movement has been in the past, and how the volume of the trading is, and they look at the chart of the stock market, and they swear by this, and then they think that fundamental analysis is useless, and these two crowds are against each other. The technical trader guys, they are more aware of this educated betting. So basically you need to have a strategy where you have an edge, just like the casino. It doesn't have to be that you have an 80% chance. It's enough that you have, like the casino, a slight edge to your side. And this edge can come from many things. For example, if we take Warren Buffett, his edge comes from the fact that he's a very long-term investor, and over a long period of time, the stocks tend to go up. So when he picks companies and he sits 10 years with them, there's a super little chance that those companies goes down, but it does happen. He also has had bad trades like all of us. And so let's say that he buys 10 companies and 9 of them double, but one he loses 100% of the money. From his portfolio overall, he still did educated betting, because with the time he has the edge on his side, right? And then you have shorter term trades, like let's say people who invest in 1 to 2 years. And it's very important that you have to think with that you have a mathematical edge. And for example, one way to make sure that you have it is that when you do bets, you make sure that your bets allow you to win enough, because you are going to have losing trades. So when you win enough, it has to offset your losses. And again, if we still stick with fundamentals, there is a YouTube channel called Jeremy Financial Education. I don't know if you know him. He's a fundamental guy who has a 3 to 5 year time horizon, and he typically likes to pick stocks that will 3 to 5 to 10x in the next 3 to 5 years. And he has lost money on trades. For example, he was an investor in GoPro where he lost about 90% of his money. But do you see here that if you make 10 bets and all the 10 bets have the chance of 10xing, and on some you lose 100% of your money, but so you could lose, because the odds are so much in your favor that you could lose 9 bets and only 1 bet plays out, you would still be at zero. You would still not lose money. So this is a fantastic way to keep this in mind. If you don't have this, like you don't buy stocks that can 10x, you're more of a safer investor. Let's say you're investing in Google, Facebook, and you think these will go up 20%. Then it's very important that in your strategy that you need to work out, that then you allow for that, then your losses has to be proportionately little. So let's say that you would then have to have a stop loss that, okay, I enter here in Google, but if it goes 5% down, I cut it. Because then you're again making it so that when you're right, you win 20, 30%, but when you lose maybe 5%. And then you can be wrong quite many times, and you're going to be, it's inevitable. All of us make mistakes on the stock market. But you still have an overall mathematical advantage on your side. Okay, so then an additional point to this is that it's crucially important that you know what type of investor you are. So I cannot tell you how many people I have seen who are long-term investors, and they buy a stock and they're saying, I'm gonna have this for the next 3 years, and then it moves 2% down, and they're like, oh my god, I'm going to sell. It's 2% down. So it's very important that if you have a strategy and you're a long-term investor, and you know that, okay, I bought this at $20, I think it will go to $100, and the next day it goes to $15, then you don't panic. Maybe you even buy more, because then it's even a better deal, because if it was a good deal at 20, then it's an even better deal at 15, because it's going to 100, right? And if you're a technical trader and you're trading based on the chart, I cannot tell you how many people I have seen that, let's say they buy Google, they buy a call option on Google because it's going to go up. A call option, you win when the stock goes up, right? And then it doesn't go up, and then normally, because you're a technical trader, you should sell. But they're like, no, but Google has these fundamentals, and it should go up, and then they stay in it and they don't follow their strategy, don't cut the loss. So it's very important. If you're a fundamental guy, trade as a fundamental guy, trade per your strategy. If you're, a short-term trader or you're a day trader, then you keep to this, and you know that that's what you are, and you trade within that. If you, again, it's also very important to know that if you know that you can't deal with this stress, then you can still invest into invest funds, and get money every month. Every time you get your salary, you set aside, I don't know, 1,000, 2,000, 500, as much as you can, and you send it to index funds. That is also a way of investing. And if you know that that's the kind of investors you are, then that's what you do. So once you know what type of investor you are, you know your strategy, and you're trading per the strategy, then the second most common mistake that I have found why people lose their money is because they're just not applying their strategy. I mean, it might sound crazy, and I've seen this in firsthand. That we were in the stock market club. We were doing a lot of trend trading, right? And then the number one rule was don't bet against the trend. So then you had these traders who would come, and then the idea was that if something is in a major uptrend, then you would only go long or buy call options, right? If something is in a major downtrend, then you would only buy put options or you would short the stock, right? And then I cannot tell you how many times these guys came in and they're like, I bought a call option on this stock. And then you open the stock and the chart looks like this. It's in a complete bear market. And then you go, okay, but the number one rule of the strategy is don't trade against the trend. Yeah, but this has fallen so much. I mean, how much lower can it go? And there's a reason why I have this rule, guys. The trend is your friend, and these people have lost all their money. And it was like step one of their strategy. How hard can it be? And I don't know, for some reason it can be hard for some people. So you really have to make sure, especially this, if you're a fundamental trader, I believe it's, it's easier. You buy a stock and then you have it for 5 years. I mean, there's nothing much to apply. But if you are trading shorter term and you're a day trader, or you're a momentum and swing trader, which is the strategies that I like the most, it's crucial that you go like a robot. And when you have an entry signal, you put away your emotions, you buy. When you have to cut your loss, you cut your loss. When you have to take your profit, you take your profit. And you have your strategy before you're trading, and you don't make any decisions when you're trading, because all your strategy decisions have been made before, and then you just follow the strategy. A third point why people are losing a lot of money in the stock market, again, this is a bit similar to what kind of investor you are, is not knowing your own timeline. So I have seen people, again, fundamental, they know I bought Google for the next 5 years, it's going to 5x, and then within a week it goes 2% down. And then they start thinking about selling it, because how come it didn't go 100% in a week? Okay, so you have to know your timeline. I have seen a person very close to me who started on a momentum strategy, where the holdings were weeks to months, right? And then this person went long on a stock, and then the next day the stock went 1.5% down, and then the person was like, oh my god, this went against me, I need to sell. And it's like, no, you need to let it play out, especially when you're on this weeks to months timelines. Many times the trades go against you in the beginning, and as long as it doesn't hit your stop loss, there's no issues with that. You just stay in it, and you know your timeline, and you know what can happen, and you just stick with it. Okay, so now the number 4 reason why super many people lose money on the stock market is because they have unreal expectations, and they are trying to be rich they're trying to become rich on the stock market. Now this might sound funny, but the thing is, ideally you should earn a lot of money or make a lot of money somewhere, and then you invest this sum of money on the stock market, and then you manage your wealth, and then you try to outperform the market, which means that if you have a plus 20-30% yearly return, you're Gucci, you're Warren Buffett, which is the most legendary investor, he has an average annual return of 29%. So many newbies, they come, who is this Warren Buffett guy? Only 29%. And then they calculate out, if I invest $1,000 and get 29% return on it, that's $290. And I would work 1 year for this $290. So then they go into riskier and riskier strategies, and they're expecting to go from $1,000 to $100,000 in 1 year because they're not making enough money, their jobs are not paying, and then they have a different idea. So this is where it goes wrong. So the problem is not that the 29% is shit. The problem is that to begin with $1,000 is shit. I mean, you need to start with something, but you also need to have the correct expectations. So the way to get rich on the stock market is you practice. When you begin, you don't try to make 1,000% return. You're happy with, I mean, if you just survive your first year on the stock market and you make 2% return, right? You underperform the market, but you didn't blow your portfolio. You're already in the top 1%, or what is it, top 5% of traders. And then you have to find ways how you can grow your, like, what you have invested in the stock market. And yes, when you have 100,000, 200,000, 500,000, $1 million on the stock market, then this 20 to 30% becomes a substantial amount. But I see that a lot of people, again, they have maybe a job at McDonald's, and then they see this as their like road to freedom. So they save up, I don't know, 5,000. That's how much I blew on the stock market, actually. $5,000 as a 20-year-old. I started option trading. I violated every rule. All of these that I told you, I violated, right? And I in a month blew my account. The first year, you shouldn't even try to get rich on the stock market. You should just go for like, I'm gonna survive the stock market. And then of course you optimize, you correct what you're doing. And then basically you will come to a strategy that works for you. And then you will start getting this 30, maybe even 50% per year. And that is amazing. And then you have to find out, okay, how do I grow my capital so that, because yeah, I mean, 50% of $1,000 is $500, and it's not gonna be anything, but somehow you need to get up that amount so it can be a meaningful return on the stock market. And then here is number 5, which was quite shocking with me. It actually blew my mind. So the fifth reason is that people don't have proper stop losses and they don't manage the risk of their portfolio. I was actually watching a YouTube video by a guy, I don't remember his name, but he was doing mathematical calculations of different strategies. And what blew my mind is you can have a winning strategy. Let's say that you have a strategy where each time you win 20%, each time you lose 10%, right? And let's say that in the strategy, you're 70% right. So based on all this, it's a winning strategy. But you can have a losing streak in the market because, these stock market strategies, they don't work in a linear fashion. So it's not like if 7 times you're right, it's like you have a good trade, a good trade, a good trade, a good trade, a good trade 7 times, and then bad trade, bad trade, bad trade 3 times, and then good trade, good trade. It doesn't work like that in life. It's like you get a good one, you get a bad one, then you get a bad one, then you get a good one. And he mathematically proves that you can, if you don't have a correct portfolio management, meaning that you risk too much of your portfolio, even with a winning strategy, you can wipe out your account. And this is when I understood that when I was in the beginning of my 20s, it was actually my teens, and I blew this $5,000 on the stock market. That's what happened to me. I was going in options, and on each trade, I risked more than 20% of my portfolio, meaning that if the trade went against me, I went 20% down on the portfolio. And that means that I have 5 trades. If I'm wrong 5 times in a row, then I wipe my portfolio. And that's exactly what happened. Because in a technical strategy, it very easily can happen that you're wrong, I don't know, 7 or 8 times. And then you will be correct 30 times. And then you will be wrong. But if your portfolio management is not in, you will wipe out your account, and then it's impossible to come back because you have wiped your account. So generally, the rule that I apply now is that no position can risk more than 2% of my portfolio, because based on these mathematical calculations, that's like, even if I have 5 losing trades, I'm still down to 90% of my portfolio. And then if I win 10% the next trade, I'm basically back to 100%. But imagine if you lose 50% of your portfolio and you're down to 50%. Now you have to earn 100% to just go back to zero. And imagine if you would lose 70% of your accounts. So you would go down from 100 to 30, then you need to more than 3 times your money just to come back to zero, which is insane. It's actually more important to keep your losses down than making the gains, because that's where you really mess your portfolio up, when you start going below the original investment amount. And the lower you go, the harder it is to come back. It's a long video. I hope you got a lot out of it. So basically, know what kind of trader you are. If you are a fundamental trader, amazing. If you're a technical trader, if it's all of this is too much for you and you want to invest into index funds, completely fine. Then trade like this, know your strategy, apply your strategy, know your timeline, don't have unreal expectations, and make sure that you have a very good risk management to your portfolio. And if you follow these rules, you will be in the top 1% of traders who make a lot of money on the stock market. If you're one of those guys, please make sure you subscribe. I would love to stay in connection with you. And I will see you in lots of future videos to come, where we discuss a lot of strategies so we can make your trading better. Thanks for watching, and I will see you in the next video. Bye bye.